All right, let's see. What is a good setting? 10? I think that's a good setting. I think that's a good noise setting. Yeah, let's go over here. Oh, you guys will appreciate this. I had an email from somebody from the Monday Morning Live days, MML. They said, "Listen, we're just not sure about this new program that you guys got going on. We recently, well, first of all, here was the caveat. We're really into the crypto space. We recently logged back into Monday Morning Live after 7 months to see your content because we follow closely. You follow closely and you missed the last 7 months in crypto? That'd have to make you stupid." Anyway, then they went on in a series of paragraphs to entice me and or Brandon, or both of us, to convince them to do the digital investors, the streams. You can't make this stuff up, people. I said, I would read you the email response, but most of it's not appropriate. But I said, if you haven't checked the market out in 7 months and you expect me to convince you to watch our content, we don't give a shit. There was some other things in there too. Like, come on, man. You know, part of this whole thing is that people take responsibility for their own financial actions and activities. So like, if you've been asleep at the wheel, it's the same thing as all these people that show up, all these Johnny-come-latelys, like, hey, crypto. You're like, buddy, we've been talking about this for 9 years. Now it's, hey, crypto, like, kick rocks, dude. Go down the road. Go watch whatever investor materials they give you at Fidelity or whatever. There. Anyway, I just thought that was funny. And so I don't think that they'll be joining us with their support or membership. Okay. Let's see. Who did I not? Hello. Oh, Chris was the last one. Hello. 11. L11. I think it's like L11. I don't think it would be L11. L11. That's like if your name was Lloyd. Is it Lloyd or Lloyd? Hello, Lloyd. One of those L's is silent. Hello. Yeah. No, I guess it was the old one. I don't even know. It's impossible to figure people out. I mean, talk about some Johnny-come-lately crap. We're really into crypto. We haven't paid attention to it in 7 months. I hope you're not really into your children. They're dead. All right. No, I said it nicely. I said we don't give a shit. It's like if I'm going to answer an email like that, come on, man. God. Okay, let's see. Howard, what up? Hello. Okay. I think it is dissolved. I mean, I don't think it exists, but that means that even before it exists, they weren't paying attention. They're like, what? Hello. Tom and Chris are still operating. Oh, really? Why? People are still losing money with those guys. God. I like them both, but they can't invest their way out of a paper bag. I mean, they're nice guys that are fundamentally flawed in their understanding of how markets work in finance. Go ask them to tell you how a yield curve works, or what repo is. If you don't know how the gears in your watch move around, don't go opening up the watch and trying to fix things. Yeah. Shah's a piece of shit. I'll say that out loud. He worked actively in the background to subvert what we were doing over at MML. I'll say it. Shah is a piece of shit. And intellectually, he's a tiny, tiny little midget. But, I'm not one to talk out of school. And the thing is, Howard, Tom and I really get along well. Like I get along well with Tom. I get along with Chris. I got along with everybody. I didn't like Shaw because he was actively trash talking what we were doing, and he was wrong. I mean, he was flat out, soup to nuts wrong. Tom, I actually like we spent some time together on a few different occasions. Tom and I hung out, and he was fun, man. He's a fun guy. I'm not going to do anything that they say investing wise, but Tom was really cool. And Chris was cool. Chris was super cool. Again, they don't know anything about, investing, but they're cool dudes. Listen, Garrett was amazing. Garrett's the smartest guy that can't invest, period, in the world. Garrett is a legit, knows his shit genius, but he can't get out of his own way when it comes to investing. And yeah, Shaw's incredibly arrogant. And it's one thing to be arrogant if you're right every now and then, but if you're wrong all the time, his problem is he's really, really on the shelf. And so only time he's going to make a shift is if everyone else in the market shifts, 6 months later, he'll be like, I told you so. Like, what are you talking about? You can't told you so. You're not even here yet. It's like the guy that's late to the party. Like, finally you guys get here. Like, we've been here, buddy. We've been here for 4 hours. We're winding this thing down. Yeah. And yeah, again, nice guy, terrible at money. And this is the thing. There's a lot of people who are very nice, very cool, very well-intentioned. Like none of those guys want you to lose money. None of them. Like that whole crew, there's not anybody there that wants you to lose money. But this is just in general. I'm not talking about just there, but in general. But there's just only a few people that get it. Even if you look in the crypto space and all the talking heads, the Novograts and all these kind of jackasses, they're dudes that were early. They got, $42 Bitcoin and $6 Ethereum. And, and so you look at their track record and they got rich one time with one bull run in 2017. That's it. That's it. And since then, they never understood it anyway. And so now they're parroting out their old school Goldman Sachs bullshitty salesman-y tribe, their drivel. And a lot of people get sucked into it, man, because they're like, well, he's rich. Like Novogratz is the greatest example. He talks well and he's rich. Has he made any money in the last 5 years? Absolutely not. They've gotten destroyed. His fund, Galaxy, Galaxy Digital, is losing about $250 million a quarter for its clients. Well done, Mike, because you fucking get it. He was losing money in a bull market. He's the only guy dumb enough to have lost money when Bitcoin went from 25 to 50,000. You got to be about stupid. Ethereum went from, what was it, about 1,600-ish, floating around there, 1,400 at the bottom. And then I'm just trying to think of the last quarter when I read their filing. Of course, it's in Canada, not in the U.S., because he can't open a shop in the U.S. So it's like, and it's the same typical MO. Goldman Sachs DNA fired or left for some reason. Goldman Sachs, and it's all these guys. It's go look under every dirty rock you see, there's Goldman Sachs, scummy little eels swimming around underneath there. So you go, okay, him, Raoul Pal, all of these dudes, and then you look, every one of these gurus that was fleeced by Luna and UST, you gotta never listen to them again. Like never listen to them. I know that's the funny thing. If only Luna had worked. I mean, excuse me. I'm gonna pitch you guys a new project, okay? Here we go. All right, everybody, new project. It's called Muna. Now, there's an unlimited supply of Muna, but if you buy Muna, I'm gonna create a stable coin called USDN. All right. We'll call it USD. The N stands for nonsense. USDN. USDN, you're going to burn Muna, and I'm going to give you USDN. Then if you lock up the USDN, remember, USD nonsense, I'm going to pay you 20%. You got to lock it up. But I'm going to pay you 20% on your money. Stablecoin. It's a stable coin that I'm going to pay you 20% annualized. Who's in? Who wants the Muna? No, I think we do it MOOOOONA, just like that. Five O's. Yeah, and we'll only take Solana and Luna, the old Luna, the second Luna, FTX coins, if anybody has those, FTT tokens, that's all we'll take. That's all we accept from Muna. Anyway, you see the nonsense of it. What is the line in the sand where you need to ask a question? If someone says they pay X%, what is the line in the sand where you feel uncomfortable and you feel like you need to have some kind of real justification for them paying that rate? And as a bonus, why is that line in the sand? Why did we, the line in the sand that we have, yes. Why did we set that? What else pays in that range? And that should send off our antenna, our alarm bells. It's 6. Nope, it's 6. Dale, if you flip that over, you got it. 6. 6 is the number. And that's the key. Nailed it. Junk bonds. Okay, here's an even deeper one for you guys. What's the nice way that they say junk bonds, except without saying junk bonds, on CNBC? What's the nice way that people say junk bonds when they want to paint it up and make it seem like something fancy? There's a certain way they say it. Oh, wait, give me a second. I gotta check something. Okay, it was just the green guy. Remember, I'm doing my trash can hustle today. It was just the first one. It's just the green one. High yield, you nailed it. Everybody that got high yield, let me give credit where credit is due. And Barry's the first one to nail it. Yes. Now, that's a good question, Donna. And I'm going to let you guys answer that. When you look at a project like Fetch, first of all, it pays a reward. That reward has to do with staking and the token's emanations. Now, why is it that a protocol can pay higher than high yield, higher than junk bond status? And you're right to question. You question everything high yield, everything over 6%, everything junk. Ooh, here's an even deeper in the weeds one for those of you. What is the classification between investment grade and non-investment grade? Ooh, getting into the weeds. That's right. It's marketing or it's network adoption, something like that. When Fetch is paying that 9% and change percent, it's a combination of staking rewards and network adoption. Now, in Fetch's case, Fetch is not a blockchain. Fetch is not a data structure. Fetch is a company that launched an asset on top of Cosmos, which is a blockchain and is a data structure. Okay? Triple B, Charlene crushed it. Triple B. So you have, it's kind of little pyramids that are flipped over on top of a big pyramid. You have AAA, double A, triple B, and then you have B, double B, B, triple C. So everything under triple B is junk. It's no longer investment grade. Now, why is that important when you're looking at the makeup? People keep calling me. When you're looking at the makeup of like a pension fund and things like that. Let's say we're gonna do a little kind of game theory thought experiment. Okay, let's talk Muna again, the company behind Muna. Muna is in all these pension funds. Everybody loves Muna. We love Muna. They make toys also, right? Muna makes toys. And it's triple B. But we know that Muna is probably not going to make it. Muna's kind of sketchy. Now, pension funds, big funds, government funds, the firemen's union, the teachers union, things like this. They can hold investment grade debt, right? They can hold investment grade products. But what they cannot hold is anything below investment grade. So we know Muna is a garbage company run by a guy named Do Klon. And Do Klon flies around the world getting on Twitter, shit-talking people, telling them how good Muna is. He's Do Klon. He can do what he wants. He's friends with Justin Sun. If you're friends with Justin Sun, you can do no wrong. That guy's also going to be wearing orange, by the way. Anyway, so, pension funds can't have, it's not that they shouldn't, they cannot. Pensions can't have lower than investment grade. That's why it's rated investment grade. So if we think that they're going to re-rate, I mean, we know they are, but if we think they're going to re-rate Muna, the company, not the tokens, forget about the tokens. That's just an old side hustle from Do Klon. If we think they're going to re-rate that double B, they're going to knock it down a notch. What's going to happen to that equity or to their debt that's floating out there? Remember, so the scenario is it's going to get beat up. It's going to get re-rated from triple B down to double B. And once it's in high yield, it's basically got a 50% chance of insolvency. That's kind of like the word on the street. It's like, listen, if anything's high yield or junk, there's a 50% chance it's going to zero. That's kind of like the way it works. And remember, there's a capital stack. We're going to talk about the capital stack in a second. But first, we're going from triple B. We know if downgrades are coming. When those downgrades happen, what does that force onto the market? Well, they wouldn't be triple C. They would go double B, B, and then in the C's. If they're in the C's, that's going right. Well, bankruptcy maybe, but the main thing is, if it gets downgraded, all of those funds have to dump that asset. They can't hold that debt. Remember, we're talking about if the company's rating, we're not talking about like equity at this point. Like we're way past that. We're really talking about that company debt, and that's where we'll get into a discussion of capital stack here in a second. But their debt. So anyway, those funds can't own those assets. And there's all sorts of rules for what they can and can't own, but it's to protect the investors, to protect the teachers and firefighters and police officers and government workers and employees and all this kind of stuff. So Do Klon is marketing Moon. No. Do Klon. This is a different person, completely unrelated. Do Klon. So anyway, this thing gets knocked down from triple B to double B. All those funds have to unload all their exposure. They can't own any exposure to anything below investment grade. So that's going to wipe out a certain amount of investors. Now let's talk capital stack. We're just doing some old school basics. Does anybody know the capital stack? I'll give you a hint. Equity is at the bottom. Equity is at the very bottom of the capital stack. And the way you should kind of say it in your mind is first call on dividends, last call at liquidation. That's what the capital stack provides an equity holder. If you own equity in a company, you own Apple stock. If Apple goes into some kind of insolvency and they have to assets are liquidated, you're not getting anything. You're getting zero. You're not going to get made whole. There's only one group in the capital stack that gets anywhere close to being made whole. Okay? Equity holders are at the very bottom of the capital stack. So, Mary, good. Preferred is above regular equity. And yes, Joe, you're almost there. You're very close, but there's two kinds of debt or two kinds of bonds in those company bonds. The capital stack is basically 4 tiers. We now know from what we've seen here that the lowest tier of utility, yes, you guys are beating around the bush. You're close. This is in the weeds, but the lowest tier is equity, right? Then preferred or preferred shares, preferred equity. Then there's two classifications of debt, right? There's senior and junior debt, right? Senior notes, senior bonds, senior debt, junior, right? Preferred, non-preferred. Okay, so senior debt, junior debt, preferred stock, preferred equity, street equity, regular equity, dummy equity, Joe six-pack equity. You might call it inequity. Ooh, which one is that? Oh, they're green. Okay, they're just going green right now. We're good. Anyway, what you get when you own equity is nothing. You get a dividend maybe, and you get the first call for dividends, but you are last in line at liquidation, meaning you get nothing. That's why when these dudes come in with those big ass bankrolls to bail out companies, the deals are done with senior debt, not junior, not preferred. Sometimes preferred, some warrants or voting is can go along with that. But to keep it simple, the capital stack is senior debt, junior debt, preferred shares, and then just kind of like equity or street equity. All right. And what we own when we buy stock is that equity on the street, Joe six-pack equity, right? So first in line for dividends, last in line at liquidation. All right. So you can see how one little thing, if you don't understand the gears and something happens in the economy that could push a company, like you could have a slowdown in the economy that could push a company that's BBB, investment grade, like an automaker or something, into junk status. If they were teetering, now they get pushed into junk. What happens? All these funds that might have been holding them because they were paying more, because remember, the riskier you go, the higher reward you're paid as far as the yield. Okay? So they were trying to derive that yield. Why? Does anybody know what a pension fund needs to maintain investment-wise in order to cover the people exiting out the backside of a pension fund? So in the pension fund comes what? People with their money. What goes out the back? Either lump sum or annuity payments. And that's a certain number that they pretty much have to hit. It's a range. But they have to nail this each year. And if they don't nail this, they go the other direction. This is kind of why Social Security was always doomed to fail. Because unless it's a counterfeiting machine, you can't maintain the levels they have to exit. The number is somewhere between 7 and 7.5%. So Howard, if you move the 5 over to the other side of the 7 and put a dot there, 25%. Now, come on, it's not UST, Dale. No, 7 to 7.5%. That's what a pension fund needs to cover the annuities and the lump sum payments that are getting pushed out the back end as people exit. It's not a Ponzi scheme, but it's definitely an investment scheme. And most of these have a hard time making it. So what happens if you're in an environment where everything's paying 2% or 3%? And you need to be cracking 7.5, maybe higher, so that you can, build yourself a cushion. So what do these funds do? What do these fund managers do? They take on more risk. They push themselves out the risk curve. Well, what happens when you're all the way out the curve and you've got the riskiest stuff that's there, the riskiest, trashiest, borderline investment grade junk, like just about to fall off, but it's paying 5.2%. 5.2% is not 7 or 7.5. So you have a little bit of a problem there. So what happens when you're behind? You've done everything you can. You got every last juice out of the fruit. You're running a fund. You're not going to be able to meet your exits, meet your annuities, your lump sums. You can think of it as like your redemptions. You're not going to meet the money coming in plus investment is not equaling the money going out. Well, no, you're not going to sell it. You don't have anything to sell. You're an investor. Think of a pension fund as an investor, mostly actively managed. So that fund manager or group of managers is going to look for ways to take on leverage. Remember, they're limited by what they can buy. They're limited by what they can buy. So they can't just go grab all sorts of junky stuff that pays high yield because they can't have non-investment grade assets. And they might do a variety of things, but one of the things that they do is they go out on the risk curve. And when they've gone to the edge of the risk curve and they can't go any further, they add leverage. I mean, if I'm getting 2.5% here and I need to crack over 7, well, then why don't I just go take on 4x leverage? That gets us in the good. We're fine. Everything's fine. So taking on that leverage on borderline junk assets puts you in a very dangerous position. And a lot of these pension funds, I think, are going to get wiped. I mean, most of them would probably get bailed out because no one's allowed to really fail. We're allowed to fail, me and you. We're definitely allowed to fail, but they don't usually fail these funds. Someone will come bail them out like they bailed everyone else. But I wouldn't be waiting on a bailout. That's pretty dangerous. Yeah, talk to Fat Tony about a loan. Yeah, go to Fat Tony. Tell him Johnny Fingers sent you. So you could see something small in the market create something big in the market, and then watch the cascade of events. Something small in the market happens. A couple of companies that were in a lot of funds get pushed down from investment grade to junk. That's, by the way, if you can actually get the rating agencies to do ratings, because the same companies that are being rated are the ones that pay the rating agencies. Isn't that strange? Right? Like, that's a whole other thing. But anyway, if you could get the ratings agencies to not do what they do, which is sit on their hands and be quiet, if they were actually rating and they downgrade an asset or basket of assets, companies, whatever, or their debt, and they go into non-investment grade, and then there's forced selling of the asset because it doesn't meet the guidelines, parameters, whatever, of the pension funds. And this is we're just talking about pension funds, not all the other exposure that also might not be allowed to hold, non-investment grade debt. So then there's an unwind there. So then, and you see all these pension funds having to dump this asset. You're like, well, if they all have to sell, we'll short it to zero. So then the people start shorting it. And of course, they're front running that trade. And you start to see an unwind in those funds. You say, oh, some of these funds are going to go belly up. So you start shooting at the funds. You say, well, what else do they have on their balance sheet? Oh, they have this and this and this and this. They're going to have to sell this and this and this and this. So people start going into the market. And it's like shooting. You're taking shots at them. You're shooting at fish in a barrel, or like something that's slowly rotating around the toilet on its way to the bottom. And so then you have pension fund unwinds, and then you have mini bailouts and big bailouts, and all the panic that comes with the unwind of those pensions. And then that can create panic. So a little thing can create a big thing. And so the little things matter, right? In a market, the little things matter. No one knows how these things play out. Sometimes it's nothing. Look, we've had 4, 5, 6 banks crash in 2023. And I'm sure there were a lot more smaller banks that you never heard about. There is most certainly a banking crisis happening that we only just get to see very, little bitty pieces of. Like we see we hear an echo like in an alleyway. Oh, what? But we don't really see it in real time. Most of this stuff is done, very quietly. We just see the big public ones. So like that's going on. The economy is not good. And like you look at all this stuff, and then you look at financial markets and you're like, they're doing great, all-time highs. Crypto's doing great, all-time highs. You're like, this is so weird. Like, how can they both be true? And to grapple with that, you just got to keep them as separate things. There is the real economy and the world that we live in, and the flaws in that, which are many, and the realities of people having a very hard time right now. A lot of people are, well, not us, we're doing fine, but a lot of people are not doing fine. They're having a very hard time. They're struggling. And that's kind of shown its head in core sales and in very low demand for gasoline and oil products, and in slowing signs of retail growth. And like, it's pretty obvious the world is in a kind of recessionary period, a globally, what does Jeff Snyder say, globally synchronized recession. Remember they used to say globally synchronized growth. Anyway, that's kind of where we're at. And so those two things can be distinct and different, and both occur. You can have both a terrible worldwide economy with a lot of profligate behavior and a lot of bad debt that's never going to be repaid, and a lot of profligate money printing, and a lot of scandal, and global recessions, and bad core CPI, and fake CPI, and bad hiring numbers, and unemployment skyrocketing, and all this kind of stuff. And you can also have at the same time the biggest, best, most growing markets in cryptocurrency history, and the biggest, best, most growing markets in financial assets, and because they are not connected. And the way that you would look at crypto is, then you break it down into subcategories, because crypto is a very weird little creature. And those subcategories, the way I do it is I say, okay, infrastructure is a category, store of value is a category, stable coins are a category, AI is a category. There's probably other, you could say meme coins is a category. You could go down and make your arguments. Layer twos are a category, but that's an infrastructure play as well. And so, you try to invest best you can in the path of progress. Yeah. Oh shit. When they're closing the dollar stores, who's going to buy them up? The 50-cent stores? Come on. So yeah, these things can both be true. So I would just urge you to keep in mind that, and this all goes back to why you can have people that understand the macro a little bit, but they don't really know the whole picture. And their problem is they weight information poorly, or they think that because this equals that, because the economy's bad, the crypto market must be this or must be that. Because the economy's bad, all these. Now, what happens is there is a lag, and eventually bad information is bad information. So in like macro terms, bad information is good, right? Because you think, oh, the economy is getting bad news. That means the Fed will lower rates and they're going to print money. That's not what lowering rates is. And the Fed doesn't print money, right? We all know this. The Fed does not print money. They print bank reserves, and bank reserves are not money. You can't buy burgers with bank reserves. You cannot print prosperity. Can't, right? You can fake it for a few months, but you can't print, long-term free-flowing cash and credit availability and prosperity. And it turns out that the real central banks are actually just banks, because they're the ones lending into the economy. And when banks would rather hide in government debt or in some low interest rate environment, they would rather park their money there. They would rather park their money at the discount window. Sorry, bank term funding, BTF, bank term funding program, or whatever, which they just discontinued. But if banks would rather hide there and collect some 50 basis point spread than lend into the economy at 4, 5, 6, 7%, 8%, you have to say to yourself, ooh, things are bad. Bad. Oh, give me just a second. There's another truck coming. Hold on. Okay, I got to go pull a move. I will be back in 3 minutes. Sorry. Yeah, I know. I have to click. When I use an external mic, I have to click 2 buttons to get it to go again. Yes, we know. Jim, we know. Yeah, I have to remind myself I'm using this new microphone, which is a good one. I think it sounds better than the normal echo that you guys get, but I have to click 2 unmute buttons. Note to self. So I think that the failure of a lot of these gurus is they know many of the gears. They understand many of those things. But what they don't understand is how they mesh together. And they don't understand how to weight these things. What are the big gears? What are the little gears? And basically none of them understand repo, not really. Yes, my honey-laden voice. I know, Jim, I'm giving you crap. There's always like a 10-second delay. That's why if there's like a sound malfunction or all that, you should just assume that within 10 seconds we'll sort it out. And no, Barry, let me tell you what I do, just so you guys don't think I'm gross. I have contractor trash bags that I put my regular trash bags in. So my regular trash bags don't go into the trash. I have regular trash bags. 3 to 4 of those go into a contractor trash bag. The contractor trash bags get sealed. And then I have these little, like a pod of like all the trash, and it's just the right size to shove into the bin. I take the bin, I put it on the street, and I wait. And whichever side of the street gets hit first, I go out and take my extra pods, because they only gave me 1 black box, which is stupid. And then I run over and I shoot, and I seed whichever side of the street they hit first. If they hit my side of the street first, I then take my, they've undone mine. I take my pods, fill that up, and then rotate my trash to the other side of the street and wait for the truck to come back up. And I have to do this twice. I have to do it with the blue, and I have to do it with the black ones. This is my Thursday morning shenaniganery. Anyway, so one of the reasons why people get so much bad information in these financial markets and why most people don't get it is if you spend your life in sales, there's no reason to learn macro. If you spend your life in sales, there's no reason to understand anything about the gears. All you need to do is sound just good enough to sell someone. But you don't actually have to make money. Anybody can show up for a bull market and make money and have a bunch of people run in and send money to their fund. I had a guy, I was at the soccer field. One of the guys I was playing soccer with was like, hey, my buddy wants to give you $9 million to buy crypto for him. I was like, no. Like, this doesn't work that way, dude. And he's like, well, I don't understand. I don't know what to tell you, man. It doesn't work that way. You need to go tell your buddy to go learn crypto. Anyway, but for people that are spinning up funds, if you do it, like there's going to be people that spin up funds right now this year. 2024 is going to be amazing. And then people are going to be like, this guy made a fortune with other people's money, by the way. They'll do a 2 and 20 or a 1.5 and 20, something like that. And their fund will make money because everything's going up. And then as everything goes up, on the next year, they'll take in a bunch of money. They won't do the same returns. They have a bunch more money, but you know what they locked away? They locked away 2%. So they'll raise $1 billion. They'll put $20 million in their pocket, plus, their performance fee for the last year. They'll have a decent year in 2025, not as good as 2024, but because they don't know what the fuck they're doing. So how would they have a good year? They'll pace the market. And then everybody will say, hey, the market went up 48%. We only went up 30. And they're like, yeah, but we're being safe. I want to protect you from market vessel. Like, instead of I'm losing to the market, it's, oh, I'm protecting you. I'm staying safe. We're staying in cash. Oh, okay, I guess, but I don't know. I mean, I can stay in cash myself. So like, I don't know why you're managing my money. I should just put my money. You know what? I want to redeem. I want out. I'm going to put my money in an index fund. I want to passively index, whatever. But year 3, 4, 5, they'll destroy the fund. Everybody will exit. They'll redeem. But along the path, that asshole put $100 million in his pocket. $100 million. And you know what he knows? Nothing. He knows nothing. He took your money because, not yours, but like they put money in their pockets because Market went up, number go up. And people that don't want to do the work, number go up is enough for them to pile money into someone else's fund. And then when number go down, they redeem and they exit with less money. And so the story of the day is, I'm going to leave you with this. I want you to take a close look at all of the places where you get your information, where you learn about markets, where you learn about like all of your information inputs, the Toms, the Chris's, the Shaws, the Kennys, the Steve Leismans, the Michael Saylors. I want you to think about your inputs, realizing that they will determine and shape your outputs. And I want you to make sure that there is no noise in there. And if I'm noise, you got to cancel me, right? You need to reduce the noise. So let's think about reducing the noise. We'll see you tomorrow. We'll do it all over again. We got some good stuff behind the wall. We also have some Twin updates. I met with the CEO of Twin yesterday. 3 or 4 hours we hung out. I also met with the day before the CEO of Singularity Net. Toofy's coming over today. And that's it, man. Garbage in, garbage out. You just got to be so careful. All right. Stay in school. Don't do drugs. Don't do anything my poor insolvent drunk starting on a meth grandmother wouldn't do. Brandon has got to be wearing a tank top. We all know. We all know. Yeah.